2025 was a year defined by a sharp pivot in global monetary conditions, renewed geopolitical fragmentation, and a slowdown in China that reconfigured Asia's growth map, all against the backdrop of a prolonged US government shutdown and an approaching US midterm election cycle. Asset markets diverged starkly. Equities rallied on AI-driven earnings in the first half of 2025 before market jitters began seeping in for the second half. Meanwhile, bonds whipsawed on shifting Fed rate cut expectations. Commodities and crypto delivered outsized volatility. Credit markets stayed resilient, but may be somewhat vulnerable going forward if tentative concerns about private credit markets build. The 2026 outlook hinges on three variables. First, the depth of the Fed's rate cut cycle. Second, the trajectory of US-China trade tensions and tariffs. And third, whether global geopolitics, especially US midterms and leadership changes in Europe, catalyze stabilization or further fragmentation. These three factors will play out as either tailwinds or headwinds for financial markets and economies. I expect 2026 to be a year of slower, fragmented, but generally stable growth. For many economies, especially those reliant on external demand, growth may remain subdued amid weak global trade and investments. Regions with structural resilience, diversified demand bases, or stronger internal buffers are likely to fare better. ASEAN is relatively well positioned. The key risks and potential blind spots for 2026 are, first, an underpricing of political volatility. There is a risk that markets may be too complacent about the following: the US midterm outcomes, EU political transitions, Taiwan Straits tensions, and even the Middle East instability. These could actually trigger a sudden repricing in energy markets, currencies, and defensive assets. China's structural adjustment journey also remains a risk to watch. Although this is not our base case, a deeper than expected contraction in China remains a tail risk, especially if property sector deleveraging actually accelerates or consumer confidence fails to recover. Fiscal sustainability in advanced economies are also a rising concern. US and European deficits are compounded by higher defense spending and aging populations, and this could prove destabilizing for long-term bond markets. AI-driven market concentration. The sustainability of equity market leadership by a narrow cluster of AI-linked megacaps remains a question. Any earnings disappointment or regulatory scrutiny could force a broad repricing. Commodity supply shocks. Energy markets remain vulnerable to the strategy of the OPEC Plus alliance, US shale dynamics, and geopolitical disruptions. Bringing the pieces together, the global economy in 2026 is likely to exhibit the following profile. For growth, a soft landing in the US remains our base case. Growth should moderate but stay above recessionary levels. For Europe, we see a continuation of the low growth trajectory with scattered improvements in domestic demand, aided by increased defense spending. For China, we see a stabilization but no real acceleration, given that property remains a structural drag. For ASEAN, we see weaker growth in 2026. This is on account of a stronger than expected 2025 performance. Slower external demand and differentiated domestic demand conditions will mean the difference for different ASEAN economies. Supply chain diversification will also continue over the medium term. For monetary policy, we see the Fed continuing with a cautious easing cycle. The ECB is likely near the end of the cycle and will focus on structural competitiveness. PBOC uses targeted fiscal and credit tools, but may avoid major stimulus. Asian central banks were relatively early to ease monetary policy in line with stabilizing inflation, but may be near or have reached the limits of easing. For financial markets, equities are seeing sector rotation away from megacaps towards quality cyclicals and dividend assets. For bonds, we see US Treasury bond yields drifting mildly lower, or to settle within the September to November ranges with a relatively stable yield curve. For credit, investment grade is stable, but we are selective on high yield. For commodities, We see energy as range-bound, a recovery in metals if China stabilizes convincingly, and we are still constructive on gold. For FX, the dollar should gradually soften, and Asian FX should be mildly stronger. So in conclusion, the world enters 2026 not in crisis, nor at the start of a new boom, but in a phase of economic regime transition, one that is slower, fragmented, but stable. We see a slower but more stable US growth, a structurally decelerating China, a Europe that's grappling with competitiveness, and an ASEAN that's increasingly integrated into global value chains. The policy environment will also be more predictable. Central banks are entering a gentle easing cycle, but geopolitics will not. Trade tensions, political elections, and fiscal sustainability issues will continue to cast long shadows over markets. Ultimately, 2026 will test whether the global economy can navigate this new equilibrium, one in which growth is modest, inflation is manageable, and risk increasingly political rather than macroeconomic. The balance of probabilities favors stability with pockets of volatility, but the blind spots are significant enough to demand humility and vigilance from markets.